All right, let's jump right in. Today, we are talking about a seriously powerful financial tool for Kenyan investors, and that's trading derivatives on the NSE's Next Market. Now, I know, it might sound super complex, but don't you worry, we're going to break it all down together, step by step.
I mean, just let that sink in for a second. What if you could actually make money off Safaricom's price moves? Or, say, shield your entire portfolio from a market downturn, all without having to buy a single share? It sounds almost like magic, right? Well, that is the incredible power we are unlocking today.
Okay, so here's our game plan. First, we'll cover what NSE derivatives even are. Then we'll get into the real basics, calls and puts. After that, we'll look at how to visualize your trade, check out the pro's risk dashboard, and finally, wrap up with how you can actually start trading on Next. Let's do this.
All right, first things first, we've got to build a solid foundation. I mean, before we can even think about trading derivatives, we really need to get our heads around what they actually are.
So at its core, a derivative isn't the actual thing itself. You're not buying a piece of Safaricom, for example. Instead, it's a financial contract that gets its value from something else, an underlying asset. Think of it like a bet on the price of Safaricom stock, or the movement of the entire NSE 25 index. It's all about trading the movements, not owning the asset. Now, the world of derivatives is, well, it's pretty huge. You've got things like futures, forwards, swaps. But for our purposes today, we're going to laser focus on the one that's most relevant for us, options.
And here's where it gets interesting on the NSE's Next platform. We're not just trading plain vanilla options. We're actually trading options on futures contracts. Whoa, right? It just means we're making a bet on where the future price of an asset like Safaricom is going to be. It's a little layer on top, but it's a crucial detail. Okay, now we're getting to the good stuff. We know what a derivative is, so let's get into the two absolute fundamental tools you'll be using. I'm talking about the call and the put. Seriously, pretty much every option strategy out there starts with these two.
This table really lays it all out perfectly. Let's break it down. If you buy a call option, you're buying the right, and this is key, the right, not the obligation, to buy an asset at a certain price. You do this when you're bullish, when you think the price is going to shoot up. A put option is the exact opposite. It gives you the right to sell. You'd buy a put if you're bearish, if you think the price is about to tank. And the person who sold you that option, well, they're on the hook. They have to buy or sell if you decide to exercise your right. Okay, let's make this super practical. Imagine you buy a Safaricom call option with a strike price of 20 shillings. This means you've locked in the right to buy SCOM futures at 20. Now, let's say the market goes wild and the futures price jumps to 25. Well, your right to buy at 20 is suddenly very, very valuable. You get to profit on that whole difference, minus the small cost or premium you paid for the option in the first place. See how that works? All right, theory is one thing, but you've got to see it to really get it. And honestly, no professional trader would ever enter a trade without having a crystal clear picture of their best case and worst case scenarios. And for that, they use something called a payoff diagram. Think of it as the blueprint for your trade. So check this out. This shows you the two sides of a call option perfectly. On the left, that's you, the buyer. See how your potential loss is capped? You can only lose what you paid for the option. But your profit potential? To the moon. It's theoretically unlimited. Now look at the right. That's the seller. It's the complete opposite. Their profit is capped at the premium they received, but their risk, well, their risk is unlimited. They are a mirror image of each other. And guess what? The exact same logic applies to puts. It's just a different direction. If you buy a put, like you see on the left, you're betting on the price to fall. Again, your risk is limited to what you paid, but your profit grows as the price drops. The seller on the right, they're hoping the price stays stable or goes up. They collect that nice premium, but they're exposed to some serious risk if the market suddenly plummets.
Okay, those payoff diagrams are fantastic, but they have one limitation. They only show you the picture at the very end, at expiration. But markets move every single second. So to manage risk in real time, the pros use a special set of tools. It's time to meet the Greeks. Think of them as the live dashboard for your trading.
First up, and arguably the most important, is delta. This is the big one. All delta tells you is this. For every 1 shilling move in the underlying stock or index, how much is my options price going to change? It's your number one measure of how much your position will move with the market. So here's how it works on the NSE. Calls have a positive delta between 0 and 1 because, well, they like it when the price goes up. Puts have a negative delta between -1 and 0 because they like it when the price goes down. So if you see an option with a delta of, say, 0.55, that means for every 1 shilling the underlying futures go up, your option's price is going to go up by about 55 cents. Simple as that. Next up, we've got gamma. Now, if delta is the speed of your option, then gamma is its acceleration. It tells you how fast your delta is going to change as the price of the underlying asset moves. This is super important for understanding how quickly your risk profile can change. And here's the deal with gamma. When you buy an option, you have positive gamma. This is your friend. It means that as the market moves in your favor, your profits literally accelerate. But if you sell an option, you've got negative gamma. And this is dangerous. It means if the market moves against you, your losses can accelerate fast. You've got to watch this one. All right, let's talk about theta. Think of an option like a melting ice cube. Every single day, it loses a tiny bit of its value just because time is passing. That's theta. It's the measure of time decay. For anyone who buys an option, theta is this constant, silent force working against you every single day. So when they say time is money, in the options world, it's literally true. If you're long an option, meaning you bought it, theta is your enemy, and that decay gets faster and faster, especially in the last 30 days before it expires. But if you're an option seller, oh man, theta is your absolute best friend. You are essentially getting paid every single day as that time value just drips away. And finally, let's quickly touch on Vega and Rho. Vega is all about volatility. When markets get crazy, when there's a big news event, volatility spikes. Vega tells you how much your option's price will jump because of that increased uncertainty. It's a big deal. Rho, on the other hand, is about interest rates. And honestly, for most traders on the NSE dealing with short-term options, it's not something you need to lose sleep over. Okay, we've done the theory, we've met the Greeks, now it's time for the rubber to meet the road. How do you actually take all this knowledge and put it into practice? How do you make your first trade on the NSE Next Market? It's actually pretty straightforward. Step 1, you've got to find a broker that is licensed for derivatives trading. And just a heads up, not all of them are. Step 2, you'll open a special derivatives trading account with them. Step 3, you deposit your margin, which is kind of like a good faith deposit. And then step 4, you're ready to go. You can start placing your buy and sell orders. Okay, before we wrap up, let's go over a few super important takeaways. Yes, options give you incredible leverage, but that's a double-edged sword. It also means higher risk. You need to be okay with the fact that you can lose 100% of the money you put into an option, and it can happen fast. So please start with education. The NSE's website has some fantastic resources. And the golden rule always, only trade with money you are fully prepared to lose. And that really leaves us with one final big question. You now know the tools the professionals use. You've seen how they work. So the question is, what will you do with them? Will you use them for aggressive leverage, aiming for those big wins? Or will you use them more defensively to manage risk and protect the portfolio you already have? It's an incredibly powerful toolkit, and how you use it, well, that's entirely up to you.